Let's talk about the monthly dividend income company whose dividend yield is on record high with more than 6% right now. Are dividends safe? Is a stock a buy? The answer is coming right now. My name is Thorsten Tiet. I'm the founder of this beautiful website helping you to find promising stocks for your long-term investments to profit from capital gains and growing dividends. We are talking about Realty Income, whose dividends are on all-time high. Let's check if it is true. And by the way, Realty Income is not the only dividend stock with dividends close to or at all-time high. Maybe I should show you our Reits and our Reits with much higher dividend yield, at least on paper. So we see here a lot of Reits, more than 140 Reits in different industry like mortgage, retail, residential, diversified, office, infrastructure also exists, like here self-storage, data center, lodging, there's even timber and more. And if we sort in descending order by dividend yield, highest will be on top. And we see crazy dividend yields, 40%, 27%, 90%. What to think about this? Should you invest? Better not, because there's only one click necessary and you see here dividend cut, dividend cut, dividend cut, estimated dividend cuts. Even so, dividend yield, this is Office Properties Income Trust, Armor Residential, next one, dividend payer, monthly dividend payer, also dividends cut. And these are not good investments. Medical properties, also dividend cut, and so on. There are higher dividends, but if they become too high, they are mostly a value trap or a dividend trap. Let's have a look for Realty Income, and here they are, still very high with dividend yield of 6.1%, and you see here everything goes nicely up in contrast to the REITs we've just seen, and dividend yield on high. Is it all-time high? Let's find out. No, it was higher during the financial crisis, but still compared to the last 13 years, we are on all-time high and could be a buy right now. But before saying so, we need to check if dividends are safe. How do we do this? It's easy. First thing is, let's look if dividends are covered by the funds from operations and adjusted funds from operations, and yes, they are. They are right now. These are the last 4 quarters. This is the last business year, last 4 quarters. This is the current, still ongoing business year, ending in about 3 months, close to 3 months, and these are the next business year. So dividend, according to right now, are covered, and according to analysts, they also will be covered in the future. Want to dig a little bit deeper? We can do so, going to investor relations, and here we see the tenants. We now have a look at the tenants, if it's plausible that at the current time, or that the dividends are safe, because the funds from operations are still inflowing into the company, and this depends on the tenants, if the tenants are still going to pay the rent. So Realty Income is mostly retail with more than 80%. You can also see it here in the segment report. Realty Income changed their segment reporting, was very detailed till 21 business year. Now 22, they just say not anymore, not longer drugstore, dollar store, health and fitness and so on, but they just say retail. So retail is more than 80%, some industrial, and then anything else is completely negligible. And it's the same as we do have here. And this is interesting. This is a little bit more interesting in my point of view, because these are the biggest tenants, accounting for about 1/3 or a little bit even more of the income, of the revenue stream of Realty Income. And when we take a look at these names, we see that there are many names we already know somehow as stockholders, because these are companies you can invest in as a stockholder also. And I made a little check, or we do it right now. Let's turn off the filter, and then I have here something nice. abracadabra, I added here a list, a stock list, and this is the result. And these are tenants, major key tenants from Realty Income. And these are also stocks you can invest in. And these are mostly, except Dollar Tree, also dividend stocks. Some of them with even rather high dividend right now. Walgreens a little bit in crisis mode. Then you have CVS, then these different dollar stores, lower like Home Depot, 7 and 9 Holdings, and so on, FedEx, Walmart, and so on. And these are, even if stock price of some of these stocks and the fundamentals are not that enthusiastic right now for different reasons, these are very solid companies. And if, for example, Walgreens, if this pharmacy chain won't be able, by the way, I just analyzed Walgreens, and for me Walgreens is not a buy. Check out this video here. But if, for example, Walgreens, the turnaround does not work, what will happen? Will they stop to pay the rent? No, they will stop paying dividend. They will cut the dividend, but they will still continue to finance their business and paying rent. And the same for all these other companies, but most of these companies are very solid. You also see it here with the high ranking, especially if we make dividend income ranking, but because here most of these stocks are good for dividend income investors. So it's solid stocks, and this is another point speaking for an investment in my point of view of Realty Income. Here we are back at Realty Income, and what do we do now? We can also continue to check if dividends are safe. What else can we take a look at? For example, we can take a look at the occupancy rate, and this is here. And the history of the occupancy rate, current occupancy rate 98.2%, higher as comparable occupancy rates, and even during financial crisis and here Corona lockdowns, occupancy rate was still high, above the average of, here you see the S&P 500 Reits. So it's a very solid business. And what else can we do to determine if dividends are safe? Of course, we can look at the debt. The debt we have here, it's the interest-bearing debt. This is the debt which is a really burden for the balance sheet because it can generate interest which need to be paid. It's an outgoing cash flow. If we take a look at the complete total, then we see that the absolute total amount of interest-bearing debt goes up. It's right now 20.1.5 billion US dollar. This jump in debt was due to the acquisition of Reits. And what's more interesting is if we take a look at the debt ratio, because the debt ratio is decreasing, it's not increasing. The absolute amount of debt is increasing. The ratio comparing debt to assets is decreasing. Even it's decreased from about 45 to around 40%. Now it's slightly below 40%, which is already a good sign. We can dig even a little bit deeper. We can take a look at the amortization power, and the amortization power tells us the real incoming and outgoing cash flow. It takes the free cash flow, and then we can create a relationship between the free cash flow, although it is a REIT, the free cash flow, and we can compare it with the dividends, subtract it from the dividends, and then we know if there's still a rest, what remains, or if there's still something remaining or not. And this is the amortization power. Okay, let's make it a little bit more concrete so you see what I mean. We have a free cash flow of 2.7 billion US dollar and dividends of close to 2 million US dollar, which means we have a plus of more than 730 million US dollar. And how much is the interest-bearing debt right now? Interest expense is 600 million US dollar. And After subtracting dividends from free cash flow, we even have more than 700 million US dollar. So it's very good coverage of the interest. So interest is not that high, and I can show you that the free cash flow makes even sense in case of Realty Income. Just compare the free cash flow with the funds for operations in the last years, and you see, especially in the last years, it's basically the same. It was just a little bit higher in the past, but now it's basically the same. So this calculation to create the relationship between using the free cash flow and the interest expense makes really sense. So free cash flow minus dividends, there is still a surplus, and this surplus, called amortization power, covers the complete interest expense right now. And the interest expense was already subtracted from the free cash flow. This is the clue. So it's very solid, in my point of view, revenue stream and still solid balance sheet. But now you will say, yeah, but the debt will rise or the interest payments will rise because the interest rates rose. They are up to 5.5%, the Fed fund rate right now. Then yes, it's true, but we have this 21.5 billion US dollar in debt, but just 4.2 out of these 20.5 billion US dollar are due before between 26. So in the next years, there will only be 4.2 billion US dollar, which need to be prolongated because they matured. Which means that the higher interest rates won't apply to all this debt amount, 21.5 billion, but just to this tiny percentage made of 4.2 billion. So I see there no problem. And let's have a look at the box plot. This is from the Fed. These are the Fed committee members. And I just told you that here, 24, 25, it's only this 4.2 billion. And then in 2026, interest rates should already go down. They should already go down in 25. Probably this is the best guess from these people. And they should know. Of course, nobody knows, but this is the tendency because it is clear that we won't have interest rates of 5.5% in the long run. So the target is somewhere here between 2 and 2.5%. And this is where they see the interest rates in the longer run. And when this happens, the financing costs go down again. And when this happens, stocks, high dividend yield stocks like Realty Income will become more interesting for investors. And then you can expect not only the dividends, but also capital gains. This is the last thing we do. We take a look at the fair value of the stock. And we have two fair values which might be interesting. The first one is based on dividends and the second one is based on adjusted funds from operations. And if we just out of the box at these two, we get two fair values which are close to each other. Let's zoom in a little bit. Current stock price, $50 US, fair value is depending on what you take between 68 and 74 US dollar. So the stock seems to be clearly undervalued. Now I could say the Fed funds rate is 5.5% right now. So I won't accept a dividend of yield of just 4.4% to create or to determine the fair value. So let's make 5.5%. And then the fair value sinks, go to 55 US dollar, and still the stock looks undervalued right now. We can do the same adjustment with the price earnings here. It was 80.5 in the last 10 years, currently it's 12.6. Let's also adjust this, make it much more conservative by adjusting it to the current stock market level. So telling me that the current multiple is a fair value multiple. So it really goes down right now, even below the fair value dividend. And this is the most conservative approach, in my point of view, you can do. And now we can calculate the expected yield with this approach for till 25, because this is even more conservative, because here you see that the analysts estimated already adjusted funds from operations in 26 with a RFFO growth increase. But these are just two analysts. We skip this. We stay here. We stick 25. And when we do so, we have an annual yield, expected annual yield of 9.5%. And this is extremely, in my point of view, very conservative. I make no recommendation here, buy the stock or don't buy it. It's your decision. But in my point of view, this annual yield we have here now is really conservative, and I could double it. I could create an 80% expectation and could still defend it. It would still be plausible. I would find arguments why 80% are also realistic. But just 9.5% in my point of view is already above market average. And so this is also my conclusion. For me, Realty Income is a buy. And not only I say this, but I already did it last week. I was buying Realty Income in my own portfolio and into the company's portfolio as well. So I am long now Realty Income. Of course, I hope I am right. Now it's interesting what you are thinking about Realty Income. Are you invested? Are you going to invest the stock, or is there something I did miss? And are you critical against the investment in Realty Income? Tell me, drop comment below. I am happy to discuss. Thanks for watching this video and see you next time. Bye bye.